Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of the corporate world. Get ready because today we are diving deep into Golub Capital BDC 4, Incorporated.'s latest quarterly report, and let me tell you there are some numbers here that really tell a story. Before we jump in, if you love getting these straightforward breakdowns of complex financial documents, make sure you hit that subscribe button and the notification bell. Also, if you want to dive deeper and discuss these findings with other eager minds, check out our Discord community linked in the description below. Alright, let's start with the company's financial health on the 31st of December of last year. Their total investments, the core of their business, stood at a whopping $2.4 billion. This is a significant jump from around $2.2 billion just 3 months earlier that shows they are actively putting money to work. Looking at their total assets, which reached over $2.5 billion, clearly the company is growing its investment portfolio quite a bit. Now, a major part of their balance sheet is debt, which stands at over $1.3 billion. While this is a lot of debt compared to their net assets of about $1.17 billion as of the same date, it means they are using leverage, which is common for these types of companies, but something we always keep an eye on. Let us look at the company's performance. For the last 3 months of last year, their interest income alone was over $53 million. This is the money they earn from the loans they have made. Adding in other income sources like dividends and fees, their total investment income for that quarter was close to $57.4 million. But of course, they have expenses. Their total expenses for that same quarter were about $35.8 million. This includes interest on their debt management fees and other operating costs. After covering all their expenses, they were left with a net investment income of just over $30 million for that 3-month period. That is a pretty good chunk of change. Now here is where things get a little less clear-cut. For net gains or losses from selling investments, they actually reported a small loss of $112,000. This means they sold some investments for less than they bought them for, and looking at the changes in value of the investments they still hold, they had an unrealized depreciation of about $154,000. This means the market value of some of their investments went down on paper. It is important to remember that these unrealized numbers can swing around quite a bit. The real story is how they manage their overall portfolio and what that means for their future. When you look at how they value their investments, especially those that are not traded on public markets, the ones they classify as level 3, which rely heavily on estimations and judgment, you see over $2.3 billion of debt investments and close to $37 million in equity investments. The fact that almost all of their investments fall into this level 3 category highlights the importance of their valuation process and the role of GC advisors, the valuation designee. For their debt investments, the valuation techniques often involve yield analysis using market interest rates and EBITDA multiples from comparable companies. For instance, for their one-stop loans, the EBITDA multiples they use range from 6 to 20 times earnings, meaning they are valuing companies based on their earnings power. The total fair value of all their investments is over $2.3 billion. Now remember, this fair value is determined by the company itself, and a big chunk of it is in level 3 assets, meaning there is a degree of estimation involved. Their senior secured loans, which are generally considered less risky, are valued at about $90 million. That is a small portion of their overall portfolio. The bulk of their portfolio indeed consists of these one-stop loans totaling over $2.2 billion. These are the loans that combine features of traditional senior secured and subordinated loans, known also as unitranche loans. Scroll management fee $8,104 sub and NASLET. Let us talk about what these numbers mean for the cost of doing business, especially with related parties. The base management fee alone was over $8 million for the last quarter. The good news is that the investment advisor waived over $5 million of this fee. Remember, this waiver is in place until they perhaps go public or have a major liquidity event. Then there is the income incentive fee, which was almost $6.8 million before waiver. Again, the advisor waived over $3.3 million of this fee. This structure, where the advisor takes a significant cut, especially if performance is good, is very typical in the alternative investment world. Scroll net investment income. Return on equity 11.0% TWIDE. Looking at their performance as a return on equity, that net investment income for the last quarter was about 11% annualized. That is a solid return. Scroll total return based on average net asset value 11.0% TWIDE. And their total return based on average net asset value was also around 11% annualized. This indicates a stable performance for the quarter. Scroll B credit facility $196,541 SIPTA. On the debt side, they have grown their borrowing significantly with over $1.3 billion in total debt as of the 31st of December. Specifically, the DB credit facility has balances of $196.5 million, and the BNP credit facility has a much larger balance of over $324 million. Scroll 2025 debt securitization, $799,250 This 2025 debt securitization is by far their largest debt with nearly $800 million outstanding. This is essentially them packaging their loans and selling them to investors to raise capital. It is a key part of their financing strategy. The overall picture shows a company that is actively investing and leveraging its capital base. While the sheer amount of debt is notable, their investment strategy focuses heavily on one-stop loans, which are generally viewed as less risky within the middle market lending space. They also have a significant amount of uncalled capital from investors, meaning they have more dry powder to deploy. Now, what does this all mean for the company's direction? They are clearly focused on growing their portfolio aggressively using debt to juice their returns. The waivers on management and incentive fees are a good sign for current investors, ensuring that the advisor is incentivized to perform well before a potential liquidity event. However, the heavy reliance on level 3 valuations means we should always look at these numbers with a critical eye, understanding that the fair values are estimations. The key strength here is their relationship with Golub Capital, providing access to deal flow and expertise, which is crucial in this market segment. A weakness could be their significant leverage if interest rates were to rise drastically, or if the quality of their loan portfolio were to deteriorate. In conclusion, Golub Capital BDC4 is a growing company with a clear strategy, but like any leveraged investment, it comes with its own set of risks. The strong investment income and total returns are positives, but the valuation of their assets and their substantial debt levels are areas to watch closely. Alright, that is our deep dive into Golub Capital BDC4's latest filing. What do you think about their aggressive growth strategy and their impressive portfolio size? Let me know your thoughts in the comments below. If you found this analysis helpful, give this video a thumbs up and subscribe for more corporate decoding. And again, don't forget to join our Discord community linked in the description. Thanks for watching. See you next time.